Welcome to Market Brief After Hours. We have a massive show for you today. The markets experienced a dramatic shift, starting off with record highs in the U.S. and ending in a sea of red. It seems the wind has completely changed direction, especially after the Federal Reserve's highly anticipated meeting. Let's dive right into those final numbers. How did the major U.S. indexes close?
It was a turbulent session, to say the least. Early in the day, the Dow Jones Industrial Average actually hit a fresh all-time intraday record, its third consecutive high, but those gains quickly evaporated. By the closing bell, the Dow fell 507 points, or 0.98%, to settle at 51,493. The S&P 500 lost 1.21%, ending at 7,420, while the Nasdaq Composite shed 1.34% to close at 26,022.
That is a sharp reversal. What was the catalyst behind this sudden shift in investor sentiment?
It all comes down to the Federal Reserve and its new chairman, Kevin Warsh. This was his very first policy meeting at the helm. While the central bank did keep interest rates unchanged at a target range of 3.5% to 3.75%, it was the forward-looking projections, the famous dot plot, that rattled the markets.
Right, the dot plot. What did those projections reveal that got investors so spooked?
Well, several Fed officials signaled that they now see at least one rate hike as necessary in 2026 to tamp down on inflation. The median estimate for the federal funds rate at the end of 2026 jumped to 3.8%, up from the 3.4% projected back in March. To add a layer of mystery, Chairman Warsh actually abstained from submitting his own projection, which complicated the forecast and left the market guessing. During his press conference, he repeatedly emphasized the Fed's commitment to price stability. That sent a clear signal that we might not see the easy money policy or the rate cuts that many had anticipated earlier this year.
And bond yields reacted instantly to that hawkish tone, didn't they?
Absolutely. Treasury yields rocketed higher. The two-year Treasury yield, which is highly sensitive to Fed policy, jumped more than 16 basis points to 4.21%. Meanwhile, the benchmark 10-year Treasury yield climbed over 7 basis points to 4.50%. This surge in yields put immediate downward pressure on equities, particularly high-growth tech stocks.
We will definitely get into those tech stock movements in our Market Movers segment. But first, let's look across the Atlantic. How did European markets handle the day's tension?
Europe managed to hold its ground a bit better, closing mostly higher, though trading was cautious. The pan-European STOXX 600 climbed 0.52%. Looking at individual countries, the UK's FTSE 100 edged up 0.14%, Germany's DAX gained 0.1%, and Switzerland's SMI rose 0.39%. France's CAC 40 was the outlier, drifting down 0.2%.
Was there any key economic data out of Europe driving these moves?
Yes, inflation was the big story. In the UK, consumer price inflation remained unexpectedly flat in May at an annual rate of 2.8%, which was slightly better than the 3% the market expected. However, core inflation in the UK ticked up to 2.6%. Over in the Eurozone, annual inflation rose to 3.2% in May, up from 3.0% in April. The main sticking point there remains services inflation, which jumped to 3.5%. This persistent pressure is keeping European central banks, like the Bank of England and the Swiss National Bank, on high alert ahead of their policy announcements.
And what about the picture in Asia? It seemed like a busier day over there.
It was. Japan's Nikkei 225 rose 0.72% to close at 69,902, supported by incredibly strong export data. Japanese exports grew 17% year-on-year in May, driven by a massive 61.2% surge in semiconductor exports and a 16.4% jump in car shipments. This comes right after the Bank of Japan raised its policy rate by 25 basis points to 1%, its highest level in over 30 years, as they gradually move toward tighter policy.
That is a significant move for Japan. How did China and the rest of the region fare?
In China, the Shanghai Composite rose 0.4% to 4,108, and the Shenzhen Component gained 1.31% to 15,880. Analysts noted that the People's Bank of China is signaling a shift toward managing short-term interest rates more precisely, which helps sentiment. Elsewhere, South Korea's KOSPI 100 advanced 1.97% to 11,094. Down under, Australia's S&P ASX 200 climbed 0.54% to 8,966, while New Zealand's S&P NZX 50 slipped 0.25% to 13,392, weighed down by a widening year-over-year current account deficit. Hong Kong's Hang Seng also struggled, falling 0.74% to close at 24,312.
Fascinating global dynamics. We're going to take a very quick break, but when we return, we'll look at some surprisingly strong U.S. economic data, the latest moves in commodities and crypto, and a deep dive into the Forex market. Stay with us. Welcome back to Market Brief After Hours. Before the break, we discussed the Fed's hawkish stance. But what makes this policy path so interesting is that the U.S. consumer still seems to be running hot. We got some fresh retail and housing data today, didn't we?
We did, and the numbers show a remarkably resilient U.S. economy. U.S. retail sales rose 0.9% in May, with retail trade sales up 1.0% on the month. On an annualized basis, retail sales are up a whopping 6.9%. Meanwhile, the housing market showed a sudden burst of life. Pending home sales surged 3.8% month-over-month in May, far exceeding the market's expectation of a modest 0.8% rise. This was the steepest monthly increase we've seen since September 2024, with massive gains in the Northeast and Midwest.
With strong economic data and rising yields, the currency markets must have seen some massive swings. Let's break down the foreign exchange action, starting with the euro and the pound.
The U.S. dollar absolutely dominated today. The Euro-USD pair plunged 0.98% to close at 1.1495, breaking decisively below its recent consolidation support. This aggressive downward move has positioned the pair well below its key moving averages, specifically the 50-day simple moving average at 1.1669, the 100-day at 1.1676, and the 200-day at 1.1675. This confirms a highly negative technical profile.
And did the British pound suffer a similar fate?
Yes, GBP/USD sold off sharply, closing down 1.08% at 1.3281. It was a massive bearish daily candle that completely engulfed recent trading ranges. The pair fell sharply below its 200-day moving average of 1.3417, as well as its 100-day at 1.3460 and 50-day at 1.3472. Sellers are firmly in control here.
What about the Canadian and Australian dollars?
USD CAD accelerated higher in a powerful uptrend, closing up 0.86% at 1.4114. The pair is trading with strong bullish momentum, well supported above its 200-day moving average of 1.3820, its 50-day at 1.3775, and its 100-day at 1.3740. On the flip side, the Australian dollar weakened. AUD/USD fell 0.80% to close at 0.7009. It's now trading below its 50-day moving average of 0.7142 and its 100-day at 0.7083, though it does remain above its longer-term 200-day moving average of 0.6846.
That strength in the U.S. dollar and the jump in bond yields usually spells trouble for commodities. How did precious metals hold up?
They took a massive hit. Gold dived sharply, closing down 2.13% at $4,238. It is currently trending well below its 100-day moving average of $4,752, its 50-day at $4,566, and its 200-day at $4,437, highlighting a dominant bearish environment. Silver was hit even harder, dropping 4.17% to close at $67.04. Crucially, silver breached its 200-day moving average of $68, adding to its negative posture.
And what about oil? Did it follow the downward trend of other commodities?
Actually, oil prices bucked the trend and rose slightly. Brent crude futures settled 0.75% higher at $79.55 a barrel, while West Texas Intermediate gained 0.97% to settle at $76.79. This was driven by geopolitical headlines. President Donald Trump warned that the new ceasefire agreement with Iran was not final and that military action could resume if Tehran doesn't behave. On top of that, U.S. crude inventories fell for a 10th straight week, hitting their lowest level since 1985.
Turning to digital assets, cryptocurrency didn't escape the risk-off sentiment today either. How did Bitcoin react?
Bitcoin slipped near $64,000, caught up in the broader market sell-off. It had reached an intraday high of $66,400 earlier, but the hawkish Fed commentary dragged it down. Altcoins followed suit, with Ethereum declining 3.3% to $1,733 and Cardano shedding 4.3%. This sudden drop triggered massive liquidations. Over $400 million in trading positions were wrecked in a 24-hour period, with the vast majority being long positions.
A painful day for crypto leverage. Let's finish today's episode with some notable individual stock stories. Who were the major market movers?
Let's start with SpaceX. The hot IPO stock fell for the first time since going public last Friday, dropping nearly 5% on Wednesday. This comes after it soared almost 50% in its first 3 days of trading. Another big mover on the downside was CarMax. Their shares fell 9% despite beating first-quarter earnings expectations, with $1.31 per share versus the estimated 95 cents. It seems the stock had run up too much ahead of the report, having rallied 31% over the past month.
And we mentioned earlier that software stocks dragged down the broader market. Which ones took the biggest hits?
Adobe and ServiceNow both closed down more than 5%, while Salesforce fell over 4%, making it one of the biggest losers in the Dow. However, it wasn't all bad news today. We had some massive gainers in the biotech and consumer sectors.
Oh, tell us about those.
uniQure skyrocketed over 79%.
Some incredible single stock moves on an otherwise tough day for the broader markets. It's clear that the transition to a new Fed chairman is going to keep everyone on their toes. Thank you for walking us through all of this detailed data.
My pleasure. It is certainly a market environment where paying attention to the technicals and the central bank language pays off.
Absolutely. That is all for today's edition of the show. If you find this useful, please follow Market Brief After Hours on your favorite podcast platform. Join us again tomorrow as we continue to unpack the global markets.